In this video, guys, we're going to look at what should we do, or what could we do, if the price spikes unexpectedly in our direction while we're in a trade. Stay tuned. Hey traders, thank you for joining me. All right, so what should you do if the price unexpectedly spikes in your direction while you're in a trade? By the way, that should be what you could do. You should do what's right for you, not just what some guy on YouTube is suggesting. So pick what's right for you, but the key thing here, guys, as we go through these 5 things, is that you have a plan. Now, regardless of what you do, I think the real kind of strength you get in trading is knowing what you're going to do under specific circumstances. Just like if there's an engine failure, when you're flying a plane, you have a plan for that, and it's actually a physical checklist that comes out, and you run through the checklist because people recognize that during times of crisis, we forget things. So it can be the same. Now, obviously, it's not a time of crisis, but you could obviously flip it on its head. And I've done other videos to talk about perhaps what you could do if price spikes against you. So the key thing here, guys, is to have a plan of action. So you're not just running and hoping that you're going to do the right thing. Because ultimately, I mean, if this is a swing trading perspective, different, you've probably got some time to act and think. If it's an intraday perspective, that's an intraday chart, suddenly get a spike in your favor, you probably won't have time to act the sort of time that you'd like. Because if you delay, it could completely change the outcome. All right, so let's have a look. So the first thing you could do is you could scale out half the position. Pretty sensible thing to do, I think. If you've got a position on, suddenly spikes up way more than you expected. It's just worth noting, guys, that you know, if you've got perhaps a target up here and this is a relatively small spike, you might not want to do anything at all. You might be like, okay, well, you know what, my target's here, I'm holding for my target. The fact that it's got a price spike is great. It kind of accelerates the process a bit potentially, but I've still got my target, and that's fine. We're talking now about something that's ripped really high, unexpectedly, kind of 200 pip rip to the upside, for example. You haven't got a limit in, you're still in the deal. So scaling out half is good from the perspective that it's taking off half of the kind of profit you hadn't expected off the table, but it's still leaving half to allow it to continue if this happens to be some sort of catalyst that could send this thing running for the next multiple hours, if not multiple days. So that's something to consider. The other thing is to move a stop to 50% of the move. This is quite good because ultimately what it does, it keeps you in the full size of your position. So it really maximizes the fact that potentially this could go higher, because obviously, you know, I've drawn this just here, but literally, as you probably know if you've been an intraday trader, this could move, you know, massively again in another 10 seconds, or it could move massively down. So it depends on, you know, where you see it and how you see it, of course. But moving a stop to 50% of the move is a very clinical and easy thing to do, because apart from scaling out half, where do you scale out half? How do you scale out half? Well, you try to judge where the best exit is. That's quite challenging. Sometimes that could just be going another leg, or it could be starting down. So it's a bit tricky to do that. However, moving a stop to 50% is relatively easy compared to that. It's still got to be quick, but you know, you're waiting literally for the first impulse high. So even if it does this and goes on, your first impulse high is going to be 50% will be here to here. You're taking a halfway point. You're putting a stop in at halfway. Now, of course, you can adjust that and say, you know, 75%, 25%, whatever the percentage, doesn't matter. The point is you've got a plan of action. Like, right, it's hit high, bang, quickly put a stop in. Now, of course, the beauty of that is it stops you getting caught out on just a nothing spike. If it comes straight back down again, you're going to get stopped out. You probably get a bit of slippage, but at least you're going to be able to bank that before it completely reverses, because occasionally we get this spike, it completely reverses, takes out the low and just rips to the downside. So that's banking some profit with also allowing the trade to continue if that should be some good news that's going to rip this thing higher. The other one, guys, is adding a trailing stop. Very similar, a bit more powerful, not always supported on platforms, but it's an option. Obviously, you could do it manually as well if you happen to be in front of the screen and you want to be doing that. You put your stop in, and then, of course, it just trails up and trails up and trails up. So you're trying to capture really as the price goes up, expecting at some point perhaps to reverse, but you're trying to catch that impulse, because the key to this, guys, as the challenge is, we know, is how far does this impulse go? If we knew that, it'd be great. So we're trying to find the thing where we try to maximize this impulse. We don't want to come out too early if it's a trade that could be running on quite a long way, and of course don't want to give gains back that we've got. So it's that fine line and balance. There's no real right or wrong answer, as always, to trading. There's always that grey area, but that's something you could do. Put a trading stop in and trail the thing up. At least then you're locking in gains if it does reverse. And of course, you know, if it starts to carry on and you've still got your stop 50% here, you're giving back quite a lot. But if it's got a trailer, it's going to trail up with it. So that's something to consider. The fourth thing, guys, is just to exit all. So you could just say, right, the price has moved up, the price has spiked, we've gone from here to here. As soon as I recognize I've got a spike out of nowhere that is a surprise spike, I'm going to take it as a gift and I'm going to exit all. I'm not a huge fan of that because I think that it's worth giving or leaving opportunities to give some back, or not opportunity, give the chance, should I say, to give some back for a bigger gain. Because often, I mean, recently, it's not been the case. Recently, we've had tweets coming out and sort of instant stuff that spikes stuff and spikes stuff back. So it's obviously got to be relative and relevant to the current conditions. But, you know, if you probably look back multiple years, you probably find serious spikes very often will continue. And what you don't want to do is just grab something and you've seen it in 1 minute spike up. It spiked up, say 70 pips, you grabbed it, and then it just goes on to rally another 300. You know, you want to be able to capture that because you've been given an opportunity to make, you know, far more than you thought you would. And so in some ways, exiting all is wasting it. However, I don't think if it's a decision you make, then that's absolutely fine. You might say, listen, you know, my risk reward ratio is what it is. You know, whatever the kind of thought process goes behind making that decision is fine, but I'm not a huge fan of it, but it is an option and I understand why people want to do it. It's like, cool, I've seen this very quickly. I don't want to lose it. I don't want to see it coming back. Maybe, you know, for whatever reason you want to take off the table. So fine. Another thing is a fifth one, just put this on here because it's an option, and that's to add more. Now, the advantage, of course, of adding more is you're making the assumption this is a catalyst that's going to reprice this thing significantly, it's going to carry on higher. And your belief is that you are at the beginning of a strong move that's now going to, you know, rip up, and you think your kind of opportunity here is that you're first to the punch. Okay, not the HFT guys who managed to get it off the news, but you're first compared to some of the slower moving institutions who are now potentially going to move in. Now, of course, the danger of that is that, you know, very often these things will reverse and spike back down. If you've added more, assume you were long here, you know, your kind of break-even point becomes very vulnerable right in the position of that. So, you know, I'd be cautious of that as well, and that's not something I would do because I feel you're reacting. You end up, it's very difficult to time it as well. You know, because ultimately as well, guys, you know, this thing could move up to here, but it could pull back and then start to go again. So adding more just really ruins things for you. Of course, if you pulled your stop up, you'd be stopped out, but at least you've got something in the bank to show for it. If you've added more, then you lost money on that trade, but, you know, you've ruined an opportunity there. So adding more on a spike, I don't think is the right thing to do. However, if you want to add more after you see a price pattern, then fine, it's a brand new trade settlement. It's probably something separate to this spike. You know, if it's spiked up and it started to kind of flag reverse and go again, and you want to add more and treat it as a separate trade like that, then that's fine. That's something completely different. But just adding more on a spike, you know, I think is quite a dangerous game to play, probably because of the whipsaw nature of the spike. So those are the 5 things that I think you could do if price spikes. I like the kind of trailing stop and moving a stop up, locking some in. At least then it gives you time and clarity to think. The advantage of having that stop there is that you can say, right, what's caused this? Do I believe this is something that's got some legs to it? Do I believe, and you know that you can start to dig around and find out what's happening and not worry you're going to A, reverse completely and stop you out down here, and B, you're going to lock in some profit. So it gives you that little bit of thinking time, especially with a trailing stop as well. If it carries on and carries on, you know, you're locking in more and more profit. But all of these are perfectly fine under different circumstances and for different traders with different goals and different strategies and different time frames, etc. But those are 5 things that you could do if price spikes unexpectedly in your favor, which is always nice. Take care. Bye-bye.